$5,000 gold just broke the global alarm system. That price wasn't supposed to print, not now, not this fast. Yet gold didn't hesitate. It smashed through $5,000 an ounce, while silver didn't follow politely. It erupted up more than 250% in a year, racing past $100. These aren't bull market moves, they're panic moves. Gold is up roughly 84% in 12 months, and silver has gone nearly vertical. That alone tells you something has snapped. But here's the contradiction most people miss. This isn't investors chasing returns. It's investors running from something. If this were inflation, markets would be calm. If this were speculation, resistance levels would slow it down. But analysts are openly saying we're in uncharted territory, where the old rules don't apply anymore. That's not excitement, that's fear. And this matters to you, not because you trade metals, but because markets only behave like this when they stop trusting the system underneath everything else. Savings, energy, supply chains, stability. So the real question isn't why gold is exploding, it's what the market is preparing for next. To understand what's happening, you have to zoom out from the price and look at the pattern forming behind it. This gold move didn't appear out of nowhere. It arrived alongside a shift that global leaders are now saying out loud. The United Nations Secretary General warned that the international order is being replaced by what he called the law of the jungle. That phrase matters. It's not market language, it's survival language. Investors are pouring into metals because they believe the institutions designed to keep the world stable are no longer working. This isn't one headline or one crisis. It's a stack. Fragile ceasefires, rising sanctions, trade threats between allies, and markets are responding with a classic signal, a flight to safety so intense it overwhelms every other asset. But here's where the story reframes. If this were just fear of a recession, money would hide temporarily. Instead, it's locking itself into assets with no counterparty risk. That suggests something deeper than a downturn. Notice what's missing from the reassurance cycle. No credible promise that the rules will hold. No guarantee the referees are still in charge. So ask yourself this: what happens to markets when the rulebook itself is in question? Here's the claim markets are making, quietly but unmistakably. Conflict risk is no longer hypothetical, and the proof isn't subtle. It's in the language being used at the very top. The US president openly referenced a massive fleet in relation to Iran, saying, "We have an armada, maybe we won't have to use it." That's not diplomatic fog, that's a kinetic threat, stated plainly. When a naval strike group is mentioned on camera, markets listen. Energy traders understand what that means immediately. The Middle East isn't just a region, it's an artery. Any disruption there doesn't stay local. It ripples through oil, shipping, insurance, food, and manufacturing. That's why the reaction wasn't gradual. Gold didn't wait. Silver didn't hesitate. But here's the part nobody is emphasizing enough. There was no walk back, no soft clarification, no denial that escalation was on the table. Markets noticed that silence. Notice what's missing from the official response: a clear off-ramp. When threats are made without one, risk models break. And when models break, money doesn't argue, it hides. This is where the story stops being about prices and starts being about pressure. Because once one flashpoint goes hot, others don't stay quiet for long. Once that pressure builds, it doesn't stay contained. It spreads. And suddenly, places that were never supposed to matter to markets are moving prices. Attention has shifted north to Greenland. The US has signaled potential deployment of military personnel and tariffs against nations opposing American control there. On its face, that sounds abstract. But markets don't hear abstraction, they hear militarization of geography. This is where the story escalates. Greenland isn't about headlines. It's about access, shipping lanes, rare resources, strategic positioning in a warming Arctic. When force is even hinted at over territory like that, it tells investors something uncomfortable. Competition is no longer being managed quietly. We've seen this pattern before. Not in textbooks, but in moments when power stops pretending to be cooperative. What was once negotiated becomes enforced. What was once neutral becomes contested. And over time, the abnormal becomes routine. Here's why that detail changes everything. Markets are panic buying metals not because they understand every move, but because they recognize the signal. When geography itself becomes a weapon, uncertainty explodes beyond any model. And that uncertainty doesn't peak quickly, it compounds. Because Greenland isn't the outlier, it's the confirmation. The confirmation comes when pressure turns inward, and allies are treated like leverage instead of partners. The US issued an ultimatum to Canada, warning that if Ottawa signs a trade deal with Beijing, it would face an immediate 100% tariff on all goods entering the United States. That's not a negotiation. That's a choke point. And it didn't arrive through quiet diplomacy. It arrived via Truth Social. This is where words and actions collide. Publicly, the system still talks about cooperation and shared values. In practice, a single trade signature could instantly detonate the North American supply chain. No hearings, no buffer, no cooling off period, just impact. Here's the line that permanently changes how this should be viewed. Markets aren't reacting to tariffs themselves. They're reacting to the speed. When decisions this large can be triggered by a post, predictability disappears. Notice what wasn't offered alongside the threat. No dispute mechanism, no timeline, no reassurance that escalation could be controlled. That absence matters more than the tariff number itself. And when predictability vanishes, capital doesn't argue ideology. It moves to the one place that doesn't care who posts next. That's when the metal trade stops being defensive and starts becoming structural. While attention stays on gold, something more unstable is happening underneath it. Silver has surged between 225 and 252% in a single year, blasting past $100 an ounce and pushing toward 110. That kind of move doesn't happen in large liquid markets. It happens when a small market is overwhelmed. This is the mini crisis stacking in real time. First, silver's market is tiny compared to gold. Second, demand is hitting all at once from investors and industry. Third, there's no pause button. When buyers rush a narrow doorway, prices don't climb, they jump. Now watch how fast this escalates. Silver is behaving more explosively than gold, not because it's more important, but because there's less of it available to absorb panic. Every new buyer matters. Every withheld ounce tightens the squeeze. And here's the pressure point. When a market moves this fast, it stops responding to valuation. It responds to availability. Can you get it or can't you? That's why this isn't being called a rally, it's being called a break. So the question shifts again. At this point, the story stops being abstract and starts landing on real people. Because when markets panic like this, the impact doesn't stay on trading screens. It shows up in your life, in energy bills that don't come back down, in products that suddenly cost more or disappear for weeks, in companies that freeze hiring because inputs are unstable. When gold and silver surge together, it signals stress across supply chains and currencies at the same time. That combination usually precedes tighter credit, higher insurance costs, and slower economic motion. You don't need to own metal to feel that. You just need to live inside the system it's reacting to. Here's the quiet shift most people miss. As trust erodes, risk gets pushed downward. Governments hedge, corporations hedge, and the cost of that hedging gets passed to you. Notice how familiar this feels. The uncertainty, the sense that rules change without warning, that prices don't reflect effort anymore, just instability. This isn't ideology, it's lived experience. If this pattern feels familiar to you, say so in the comments, because what you're sensing isn't random, it's structural. And the structure is what comes next. What makes this unsettling isn't emotion, it's mechanics. Here's the system-level insight the headlines don't slow down to explain. Gold isn't rising because people are excited. It's rising because leverage everywhere else is being questioned at the same time. Institutions rely on trust, timing, and enforcement. When any one of those weakens, systems wobble. When all three weaken together, money looks for something that doesn't require permission. Falling real yields, expectations of rate cuts, and a softening dollar are acting as fuel. The Federal Reserve is boxed in. Markets have already locked in the belief that rates must come down to keep the system standing, even as inflation risks remain. That trap matters. Here's why that detail changes everything. When central banks are forced to choose between stability and currency strength, markets assume currency loses. And when that assumption spreads, it becomes self-reinforcing. This isn't chaos, it's incentive alignment. Everyone acts rationally, and the outcome still feels dangerous. That's why this move feels smarter than panic. It's a system quietly repricing what safety actually means. And once that repricing starts, it doesn't reverse easily. From here, the path forward splits, and neither option is comfortable. One path is temporary stabilization. Tensions cool just enough. Rate cuts arrive. Markets breathe. Gold pauses, maybe even pulls back. That's the outcome many are hoping for. But notice the condition it requires. Nothing else breaks. No new flashpoints, no surprise tariffs, no sudden shortages. In the current environment, that's a fragile bet. The other path is momentum. Pressure continues, not explosively, but persistently. China's appetite for silver accelerates as it feeds solar panels and electronics. Physical inventories tighten further. Analysts already describe the market as already tight. In that scenario, every dip gets bought because the underlying forces haven't changed. Here's the key uncertainty. This isn't about one decision, it's about sequencing. Which move comes next? And how fast? Markets aren't waiting for confirmation anymore. They're positioning ahead of it. That's why selling pressure is being described as modest. Nobody wants to be early exiting what might be a structural shift. And when positioning replaces prediction, reversals don't come with warnings. They come after the fact. Here's the insight that ties all of this together. Gold didn't rise because the future is bright. It rose because the future is uncertain in a very specific way. Not collapse, not boom, recalibration. A world where power is louder, rules are thinner, and safety has to be held, not promised. Analysts are already saying this move is no longer just about short-term speculation, but a global market recalibrating for conditions expected to last well beyond the next cycle. That's why selling pressure stays low. People aren't trading this, they're settling into it. Reframe the entire story in one sentence. $5,000 gold isn't the top of a rally, it's the price of entering a different era. And here's the loop. If this is a recalibration, then the real story hasn't peaked yet. It's still forming, decision by decision, post by post, flashpoint by flashpoint. If you want to understand what comes next before it shows up in prices, stay with this channel, follow, subscribe, and keep watching. Because the market has already moved on. Most people just haven't noticed yet.